stocks are rising at all-time highs, but the question is how long can they stay at these levels without rising or going down? With all of the moving pieces, we got new trade deal news, rate cut talks, and mixed signals from both bulls and bears. This market's bouncing on a fine thin line, and I want to talk about everything involved. So let's begin by looking at how stocks have performed the last 3 sessions, wrapping up June, just going up. So June was wrapped up as a good month, and stocks ended out higher today than they opened at. Now, what are we watching going forward? We'll get into that, but the main moves you've seen when the market opened up today, it kind of popped, right? Well, that was due to some news on trade between Canada and Donald Trump. So today what we've seen is the Canadian Prime Minister Mark Carney and President Donald Trump spoke Sunday, and we're progressing talks with July 21st to date to keep in mind that they're aiming on having a deal by. And this was after Canada withdrew the digital services tax that Trump's seen a problem with, and this really allows them to start over on this fresh palette and re-continue these trade talks. I wouldn't say on a fresh palette, Trump's not going to forget about that, but allow them to continue talking. Now, back to stocks. Stocks haven't been this high or expensive in over 22 years, I believe, which is and that leads us to this question, where are we heading now? And as far as expensive, we'll pull up the all-time chart here. We're looking at the SPY, and we see today it's up almost 0.5%. Gave back a little bit in the hours, and ignore the lines. All we're looking at right here is that, well, Joel, stocks are way higher than they were back in 2003. Well, yeah, I gotcha. But according to earnings and price to earnings ratios, stocks are pretty expensive. Now, is that a good thing? Is that a bad thing? Are you telling me stocks are going up? Stocks are going down? Honestly, I don't know, but here's what some have to say, starting off with Yardini Research, who sees a stock market that may melt up rather than go down. So they're saying that the bull market looks like a normal one with the potential to match returns of some of the best bull markets since the mid-1960s, possibly sending the market into what's called a speculative bubble. We don't know if that's going to happen or not, but we'll keep on watching. But they're saying that the S&P support, they note, being the tariff deal optimism, all of that's really wrapped up in commitments by AI companies to continue spending billions of dollars, buybacks from these stocks, and then record high forward price to earnings estimates now about 21.9. They see beats in the second quarter earnings, and that's what we'll be watching. But Yardini Research aren't the only bulls out there. We also had Mike Wilson, Morgan Stanley's top equity analyst, who sees the market strength being justified over at least the 6 to 12 month time frame to a few different reasons, right? So the first being the earnings as the fears fade away about possible tariff damage, as earnings revision breadth, which is a measure of how widespread positive or negative earnings estimates changes are. And these earnings revision breadths, so them changing their earnings outlooks for these companies, have risen. They have risen. So they have risen from negative 25% in mid-April to currently negative 5%. So up about 20%. They're still negative, but that's quite the increase, kind of pointing to stronger earnings ahead than was expected previously or priorly in this year, mainly in these large cap stocks outperforming economic growth because of the weaker dollar and tax incentives from the big beautiful bill. Secondly, Wilson sees the Fed cutting interest rates 7 times in 2026 as unemployment becomes more of an issue than inflation is. So that's interesting. And as they don't see tariffs being sticky, they see the labor market continuing to deteriorate, which is in line with what others seem to think about that stagflationary view. You got the increase from the tariffs. It might not be sticky, but you also see a labor market that's kind of giving in a little bit. And the third reason they pointed out was stock's ability to really just shrug off the noise and buy the dip, buy the dip, buy the dip. And we've faced a few different shocks, especially the latest geopolitical shock and oil price shock. And there's been all of these different shocks, the tariff shocks, and the market, like, it's kind of cautious, but at the same time, like, it's cautiously going up despite all of that news. And then finally, the treasury market's term premium, which is the extra return investors demand to take the risk of lending to the United States over a long period of time versus buying other assets, has fallen back over the last month as there's less stress about the fiscal position of the United States. And historically, now that June's wrapped up, what we see historically is that July has been the strongest month for both the Dow and the S&P 500 in terms of average monthly performance. But let's look at some of the macroeconomic risk kind of going forward, because we see these positives in the market between those two parties we just talked about. What are some of the concerns, or what should we be watching for signs of bad news? Well, the first one would be Trump's big, beautiful bill, that's expected to be signed into law by July 4th, which could be an important update on the country and the tax policy going forward, as investors are excited for some of the promises in this, especially some of those corporate tax cuts, as they can benefit stock fundamentals. Think about fundamentally the business is making money and they have lower costs for businesses, and that makes them look better. They're making more money. Trump cut corporate taxes in his Tax Cuts and Jobs Act back in 2017, which caused a rally in markets at that time and are due to expire by the end of this year, which perfect timing. So if the new bill doesn't pass, it can be seen as a corporate tax hike instead of the opposite. And that can do the exact opposite of what we just said, as far as corporate tax cuts make the company look better financially or fundamentally. Well, it'll look worse if there's these corporate tax hikes or those tax cuts go away. Now the companies have to fork over more money in the form of taxes, therefore making less money, therefore less earnings. Bad when these stocks are at 20-year highs as far as valuations. So yeah, concern regarding the bill is how it affects the United States debt as well, which impacts the Treasury General account and the moves they have to make to that. So more experienced investors, I'd imagine, like your fund traders, the high level economists and analysts, those are really who's going to be watching that as far as bond market enthusiasts. Another concern would be the 90-day tariff pause, which is almost up. It's July 9th, I believe. And there is this thick cloud regarding the uncertainty of the after effect. So the White House has really downplayed this deadline as not critical. Like, hey, we don't care if they don't want to negotiate. We're all good. We'll just assign the tariff rates if the negotiations aren't met, which there aren't really any met right now. So this goes back to the popular belief that the worst of tariffs is behind us, and we don't know if that's the case anymore. We don't know where we're going to go with that. So if we get higher tariffs than we were expecting, so right now there's like that 10% baseline across the board, and if the negotiations don't go well, they'll just get assigned the rate. So will unlikely be the same levels at which they're at, so they could probably go higher. But do they go to like crazy high levels like we've seen, or will they just kind of be like a little higher? I doubt they'll stay the same, but that's if the deadline doesn't get extended, which Trump said he's not really planning on extending the pause on most nations, point out the most. But if we get higher tariffs, let's think about this. That'll higher tariffs, that's a higher costs. Somebody got to absorb the cost. So somebody's costs are going up. And if costs go up, the act of that is what inflation is. The rate at which prices go up. So if we get higher tariffs, higher inflation expectations, higher inflation. So I don't know, but yeah, Trump seems to say that he's not planning on extending the pause for most nations. I'd imagine the most would probably be our prime trading partners that we have. So think like China would be a big example in that. Letters will start getting sent out pretty soon before the approaching deadline so they know. And I'd imagine this adds some type of certainty to what's going on just because they like open up the letter, look at it, read it. Oh, wow, and like big old bold print, capitalized letters. Oh, that's our rate. And then we still got some time to call the, hey, that's outrageous. And then they're like, yeah, what you trying to do while we're on the phone? Let's negotiate. And that'll really depend on like their, the rate that they'll get will really depend on the relationship they have with the U.S. So one of the countries that's getting a letter sent out to them that they've already announced is Japan because I mean, apparently the negotiations haven't went well. There's this rice shortage in Japan, and Trump said they don't want to buy our rice. So that's an example of them like having some ill will towards the United States. The European Union trade chief is actually planning on coming to and taking a trip to Washington, D.C. this week to have trade talks. So there's an example of at least somebody trying to make some traction and get some going, so it's not a complete L as far as this goes. And then we're not even done talking about things that we should consider as potential risks, which would be earnings seasons about to kick off to show how companies are holding up with all of the macroeconomic challenges. Tariffs haven't shown up pretty much anywhere yet, and somewhere they're there. So some are waiting and watching to see if the companies are eating the costs or if the costs are rising in certain sectors or really what's going on with that and how demand from the consumers is holding up if that's the case. So if companies are who are eating the costs of these tariffs, then how does that leads us to the question of how does that impact profit margins, all while stocks are at high valuations led by large caps. If these large caps aren't doing well as far as their earnings and what they report and whether they're meeting forecasts or falling short and what they have to say, and if they're not doing well and they start going down, that could drag down the entire market at kind of a risky time. So there's this piece right here by Joseph Adinolfi. Trading in risky penny stocks is booming. Why it could be a sign of trouble ahead for the market. And the only part I wanted to point out right here was that, let me make sure y'all could see it. Perfect. When speculative stocks with no or little earnings start to outperform shares of companies with established track records of profitability, so think your large cap stocks, it could mean that the market is getting dangerously frothy, said Gene Goldman, Chief Investment Officer for Cetera Investment Management. It's a sign of a market top when investors are buying first and asking questions later, Goldman told MarketWatch during an interview last week. So just so we're clear and that we're on the same page, what the heck does frothy mean? So let's look it up. Frothy means made of, covered with, or resembling froth or foamy. All right, let's get even more specific because I don't think that doesn't really answer our question. A frothy market is one where investors begin to ignore market fundamentals and bidding up an asset's price beyond what the asset is objectively worth. So that's what frothy means, everybody. So as these stocks fundamentals are beginning to matter, we're at a point to where, all right, well, they matter, and it really matters most for the fundamental companies because like the rest of the economy is pretty sketch, and like honestly, the stock market's kind of held up by a few large companies that could really systemically move the market. If they start doing bad, and then like you're thinking that, and then you just kind of like peep through the hole and you see all these traders playing with like worthless stocks that could disappear and go bankrupt and are part of the pump and dump schemes and like all of the market manipulation. You just kind of see like, and then what that just said, that usually marks a market top. if earnings season comes out like bad, despite all of that other news, like don't even consider that. And then of course, what the daily Fed speak and economic data all give hints into on inflation, the health of the labor market, the consumer, and interest rates. So that's another concern. Now, regarding the Fed, and let me just pull this up real quick. So regarding the Fed, a London-based, and this is by Steve Goldstein, the wrong kind of Fed rate cuts are coming, says JP Morgan. What that means for stocks, bonds, and the dollar. So a London-based strategist at JP Morgan says the reasons behind the Fed cut that the market is excited for may not necessarily be great for stocks because they all want this rate cut. We've been waiting on it for a while. That's at the base of the cake that I've talked about before. Where they'd see that some of this could get a little sketch is based on why the Federal Reserve is cutting rates. So they go in to talk about the three types of cuts. And the first would be a scenario where the Fed is cutting because activity is clearly weakening. Okay, so maybe unemployment's rising up, or maybe that, let's just leave it there. Unemployment's rising. That's a good sign of weakness. The second would be more of a Goldilocks scenario where there's resilient growth with little inflation, so no pressure on the consumer purchasing power, and like everybody's doing fine, and there's no there's this perfect balance. So it's like, yeah, we hit our inflation goal, we hit 2%, and it's staying there. It seems good, y'all. Let's cut rates now. That would be like the best scenario, right? Like good news, like no recession, no like weirdness. We're just gonna cut rates now. But nah. The third one would be cutting even as inflation pressures still show and subside, like kind of right now where we're expecting some type of Trump tariff reaction to asset values, mainly in like inventory and goods and services sold by businesses. And then you got Donald Trump constantly bashing Jerome Powell. He even nicknamed him Too Late. You can't make this up, in his entire board. So what he said is they should be ashamed of themselves for allowing this to happen in the United States. They have one of the easiest yet most prestigious jobs in America, and they have failed and continue to do so. If they were doing their job properly, our country would be saving trillions of dollars in interest costs. The board just sits there and watches, so they're equally to blame. We should be paying 1% or better. And they say Donald Trump wrote this hand letter to Jerome Powell, and on it, he just wrote, Jerome, you're usually too late. You have cost the USA a fortune and continue to do so. You should lower the rate by a lot. Hundreds of billions of dollars being lost. No. I don't even know what that says right there. And then signed it. And then marked the little range. What does that say? No inspiration, maybe? I don't know. I don't know what the last part says. But wow. So, like that's an example. You got the president trying to pressure you to cut rates, even though, like, his same policies, I'm not saying they're good or they're bad, we're just pointing it out. And I just accidentally opened up Photoshop, so hopefully that doesn't mess up my video. But yeah, there we go. So there's inflation pressure, and the president's wanting them to cut rates. So the strategists see a mixture of both 1 and 3 happening, where there's this weakening data, this slowing economy, with inflation picking up. And it sounds like stagflation. Back to it. We got these Trump tariffs that are going to have an impact somewhere, and that increases people's idea of inflation. And when inflation expectations go up, people expect that. And then we got a labor market that the Fed, like CEOs, people expect it to have an impact. So that sounds like inflation, and that can be scary from an investor's point of view, because that's where it's like the Fed's up against the wall and they can't breathe, and they're like, I don't know what to do. They got to pick a fight. So Goldman Sachs economists expect just one-time inflation boost from the tariffs, raising core PCE expectations up to 3.4% in December, which are way higher. Let's point that out. That's way higher than the 2.7% increase in the latest 12-month forecast they given. So that raised quite a bit, 0.7%, 70 basis points. And the CEO survey found that 41% of CEOs who were surveyed plan to hike prices, while only 30% said they'd absorb tariff costs in the next year. So we'll keep watching and see how that impacts company earnings. And that just goes into the main concern, which was company earnings altogether. Because if the companies aren't fundamentally holding up, is it like allocating a ton of money to stocks right now when they're the most expensive they've been in 20 some years? Would that make sense to have the, like, I'm going to throw my whole paycheck to stocks right now? Or will I still, like, allocate, but I might do a little less than I normally do? Like, which one just makes more sense right now? Especially while stocks are at an all-time high. And we're hearing all these reports and from the Fed and what they think, and they expect a slower economy later on this year and unemployment tending to go up at some point and an increase in costs. That's not how you stimulate demand and get people on board to spend more money. If anything, that's how you get more people to want to save money. Now, one last piece. Let's look at this Chicago Business Barometer that came out. And what we've seen is that the Chicago Business Barometer produced with M&I, I don't know what that stands for. We're all learning together. So I don't know what that stands for, but fell by 0.1 points to 40.4 in June. The index is now 7.2 points below March's year-to-date high of 47.6. So it's not too far from the high, and has now been below 50 for 19 consecutive months. And I believe 50, above 50 is more positive, and below 50 is more negative. Actually, let's verify that real quick. Chicago Business Barometer, above or below 50 reading, meaning. All right. The Chicago Barometer is reported as a 50 indicates economic expansion, while a reading below signifies contraction. So let's go back to that and apply what we just learned to it. So we got real close to expansion, but then we fell back down in June to contraction. And I believe this is after, like, that's pretty recent. Like, literally this month ain't even over yet. What's the time frame on this? Does it give? I'm sure it does somewhere. Let's just continue through this. The slight decrease was driven by a fall in supplier deliveries, production, employment, and order backlogs. This was almost fully offset by a rise in new orders. New orders rebounded 4.1 points but remained below the year-to-date average. The increase was driven by a lower proportion of respondents supporting few new orders compared to May. Everybody front-ran tariffs, or at least that's the idea, so that makes sense. Supplier deliveries eased, so less getting delivered. Production PAR 2.7. This was the third consecutive decline, with the index now at the lowest since January. So that's production, okay? So less productive, less delivered. New orders rebounded, but they were still lower. Employment retraced, but sees the second highest reading of 2025. All right, so it's not all bad. Order backlogs softened 1.5 points to the lowest level since May 2020. So order backlogs, I'd imagine that's kind of what they're behind on, maybe. Reported larger backlogs in June, the second smallest percentage on record and the lowest since 1980. Inventories moderated, so inventories haven't really moved. Prices paid climbed, the highest level since May 2022. 70% of respondents reported higher prices paid in June, up from 57% in May. So people's beginning to see prices, more than half of respondents. So That's interesting. That could be a form of those tariffs finally starting to seep through and show up. Although we haven't really seen it in the data yet, though. Like PCE barely increased. The survey ran from June 1st to June 16th. I'd say that was a good reading, though. Good reading for June. Interesting. So then here's these special questions. How do you see your business activity growing in the second half of 2025 by percent? Almost 30% see no growth. Almost half see minimal growth. Almost 20% see a decline. 3% see 10% growth. Like, you're almost the top 1% right now if you're expecting double-digit growth or any growth above 5% at all. Wow. What do you expect to do with inventory levels through second half of year? So almost 40% reduce current levels is what they said. 34%, so even less people said keep them where they're at. I got this little gnat in my face. So maintain current levels is less than reduce current levels. Almost 15% don't even know what they're going to do. Wait and see. Request suppliers to increase levels. Wow, that's at 0%. And then increase levels 14%. Wow. Oh, here's that MNI. MNI Indicators produces the renowned Chicago Business Barometer, a key leading indicator of the United States economy. MNI Indicators is part of Market News International, Inc., a leading provider of news. Okay, so that's what MNI is. Headline indicator. It's a weighted composite indicator made up of 5 sub-indicators, namely new orders, production, employment backlogs, and supplier deliveries. It is designed to predict future changes in U.S. gross domestic product. So this plays into GDP, which makes sense. So that's what we got today, y'all. We had some point of views to kind of look through. Reasons to stay happy and positive about this market. And then some of the concerns or risks or just things to watch for a green light or a red light regarding these stocks. Anyways, y'all, I hope y'all enjoyed hanging out with me today. I had a new setup. I upgraded the microphone. I've been playing around with trying to get the sound to sound better, and it's been a day, y'all. So I look forward to being back. Hopefully this video sounds a bit better, looks a little bit better. Like I said, I made some upgrades to the set. This is more of a familiar look than y'all are used to. So happy to be back.